Welcome to the Florida Real Estate and Entrepreneur Podcast, where we interview the best and the brightest business and real estate leaders. Our mission is to inspire and help 1,000 entrepreneurs to start and succeed in real estate and entrepreneurship. We will give you the exact playbook to succeed in your business through the experience of those who blaze the path. We're bringing the what's working today directly to you. Let's get started. Welcome back to the Florida Real Estate and Entrepreneur Podcast. I have the most amazing guest with me today, primarily because he's a friend, a colleague, and a partner in our multifamily syndication company. So on this podcast, we've talked about everything from salon business owners to marketing agencies to real estate investors. We have not yet talked about commercial multifamily deals. And I was thinking to myself, who is the most fluent, best person I know at this niche? And it is David Hahn. David is, he comes out of the corporate world into his real estate investing and now into a second career, which is he's in law school and he's going to be an attorney, not real estate, believe it or not, but he will be an attorney in the next few years. And while he's been doing all this craziness, he's also been buying commercial multifamily assets, specifically apartments. We've been doing it together on a team, but he is like the secret sauce behind what we do because he's just brilliantly smart. He knows the numbers better than anybody I've ever met. And he's going to help us break down this commercial 122 unit apartment that we're in the process of buying right now so that we can give you all the nuts and bolts. Like, what does it take to find this deal? How do we find it? How are we funding it? And what do the numbers actually look like? So David, man, thank you so much for coming on today.
Yeah, thanks a lot, Adam. I'm super excited to be here with you and get nerdy about real estate and numbers a little bit.
Yeah, if you love talking numbers, returns, IRRs, this is the podcast for you. If not, probably you should listen anyways. Okay. All right, David. So why don't you fill in any of the blanks? Because like you've done a lot. You've got a ton of experience from corporate to diving into real estate with Melissa, your wife, into now in law school at UPenn. And just fill us in. So you started in corporate. Like at what point did you decide to get into real estate? And then how did that parlay into law school?
Yeah, absolutely. So I honestly owe my wife a tremendous amount of thanks for getting me into real estate. She was a real estate agent early in her career before transitioning into her full-time job as an airline pilot, flying the biggest of big jets. And it was during kind of the time where I was transitioning from working for restaurant companies doing operational and financial modeling for them to opening my own place that we decided to undertake our first major deal, which was a historic tax credit rehabilitation of a 100-year-old property from a vacant warehouse space into a commercial floor unit downstairs and multiple apartments on the second floor. And that was really kind of what got me started on the real estate bug. And then the second piece of it is we are always looking for ways to create a sustainable level of income and a sustainable opportunity to transfer wealth to our next generation. Neither one of us really grew up with a whole lot, and both of us were just denied significant experiences as children and young adults because our families just didn't have resources. And we want to make sure not to do that for our kids. So this is really kind of like a personal journey of being able to provide for them and also pass to them. And instead of putting our money in the stock market where we have absolutely zero control over what happens by a board of directors or this or that or anything, we're able to tangibly participate in making these investments a fantastic opportunity for ourselves. And the beauty of syndication is that we then get to share that opportunity with our investors as well.
Yeah, I love that. So you came out of corporate. Well, how about the decision to go to law school? Like, I mean, not an easy law school either. UPenn, obviously, that's academically challenging, I'm sure. What prompted that decision and why did you jump into that field?
Yeah, so I'd always been interested in law and had kind of thought about going to law school at some point for a couple of decades, but never really actually acted on it. And I finally decided that after 20 years in the restaurant industry, that it was time to start doing something that, one, gave me greater opportunities to learn new things, develop new skills, and solve new novel issues on a daily basis, which thus far it has been in talking to attorneys. It's like every matter that you're dealing with is an opportunity to learn a new industry or learn a new set of facts. next. And then the second piece of that is that I really wanted to develop a skill set that was going to allow me to have a greater, more positive impact, not just on my immediate community, but on kind of just the broader society in terms of how we think about things. I think lawyers maybe get a bad rap for being very combative in how they deal with things, but I'm approach problem solving from a much more collaborative perspective. And I think in a growing, more polarizing world, when we can step back and actually recognize that all of us are humans and many of us have the exact same goals for wanting to provide the best possible lives for our families and create a community and a society in which a rising tide raises all boats, the law is a tool that can actually do that be a tool of building rather than dividing. And so that was a big motivating piece for me.
Yeah, that's super cool. I mean, it's just a unique aspect. I know obviously you're not going into real estate, so it's not a tight tie there, but it says a lot about who you are and your character and your insatiable desire to learn and improve your skills, because that's not an easy task. A lot of us grow up thinking we're going to be lawyers or doctors. We end up in a career, and very few people midway through their life are deciding, you know what? When I was 9, I said I wanted to be an attorney. So I'm going to go ahead and start that now. So hats off to you, man. Super cool.
Thank you. I appreciate it.
Okay, cool. Let's get into the meat and potatoes of this. So a lot of people come on these things and they talk about commercial multifamily deals in a very generic way. We're in a unique position where we actually know everything about this deal and we can talk about it in a specific way. So I think it'd be really cool if we talked about this deal. So for context, last year we closed 2 apartment deals, a 134 unit and a 90 unit, which are both performing very well. And this year we finally found a deal. We've been looking all year, one that made sense for us in North Carolina. Can you talk about how we found this particular deal and maybe how we negotiated it and how we got to where we were with the purchase on it?
Yeah, absolutely. So what I'll probably do is really even start at the beginning of the year, because early in 2024, a lot of news started talking about like, oh, the Fed's going to drop rates. The Fed's going to drop rates. And when sellers hear that, they're like, I get to push my prices up, because when the rates go down, prices go up and they're all happy. So the first 3 to 4 months of the multifamily market was just a really weird time where sellers were coming onto the market thinking, all right, I know rates are at 7.5%, 8%, but we think they're going to go down. So I'm going to come back with 2021, 2020 prices when rates were 3%. And there was a lot of disconnect and a lot of just like, I'm not even going to approach your number, but I'll at least put an offer in and stuff like that. And so there's just a lot of uncertainty and a lack of really understanding of what was going to happen. Like, how are we going to bridge this gap of disconnect between sellers and buyers? And I will say that one of the beauties of our team, Adam, you and I are both part of, is that none of us are dependent on our real estate activities as our primary source of income. It's what we're doing in real estate is to build wealth for our families and build a legacy for our families. And so we're not motivated by, I have to get an acquisition or I have to generate that next piece of income for immediate needs. It's all we're looking at a 10, 20 year play on all of this at a minimum. And so it gives us tremendous ability to be patient. And so when that kind of weirdness was going on with the market, we didn't have to move. Like, we could say no to things because the numbers didn't work. Like, we can be completely guided by what the facts of a deal tell us rather than what our emotions or what we feel about the deal tells us. So as we got into second quarter of 24, deals started percolating out. This was one of them. The Triangle Park was one of them that came to me in late February, early March, so really late Q1. And the seller on this deal had gotten in when money was cheap. So he bought this property in 2021 with very advantageous terms, but his debt was coming due. And at the time, the narrative was like, well, debt's coming due. He wants to get out. He's just not sure he wants to be in the Durham market anymore. And so he's willing to sell for close to what he put in. And what he put in was he bought the property for $19.1 million, and he's put about $2 to $2.5 million in improvements in CapEx. So he was looking for like the $20 to $21 million offer. And I underwrote the property and looked at it and immediately recognized that there were some operational challenges that I was like, this is a red flag. We need way more information on this before I can even consider an offer like that. And I was like, 18.5 was the absolute max of what I would consider. And the broker was just like, yeah, cool. Thank you. But no, thank you. And I was like, well, come back to me. Cause like, I know we can do some more digging on this, but like this is not going to happen at the price that he wants. So kind of over the next couple of months, they gauged our interest, went back and forth. I started to pick up little tidbits of information about the seller and about the situation, and started to build a narrative where this was an out-of-state buyer with an out-of-state property manager that, when money was cheap, built this grand plan of, we're going to go from our home base in Texas to North Carolina. We're going to take over the Durham market, and we're going to open a property manager outlet, and we're going to buy 4, 5, 6 multifamily units and make all this money because free lending is going to stay here forever. And that didn't happen. This was the only property they were able to get in Durham before rates started increasing. But the partner property manager seems to have spent quite a bit of money starting to build out their infrastructure to get into this new market. And when the multiple properties didn't coalesce and happen, the two parties started butting heads, and it began to look more and more like we had a messy professional divorce on our hands. So rather than this being a purely like business transaction of, oh, we're buying a business from you and we're giving you money and we're going to make profit off of it, is there were, on the sell side of things, a lot of emotions, a lot of negativity, and a lot of conscious action to try to injure each other. And I immediately recognized that, like, if we can validate that this is a great property in a great area, and the overall numbers of it indicate that there's a very high likelihood of success, that once we take this over, we can implement our operational strategy, we can probably make this happen. And thanks to the fact that we've got some fantastic lending partners and some other people who understand the level of analysis that we went into, we were able to do some pre-analysis of it and figure out that if we could get the price to a certain point, we could actually come in and make an offer and almost act as a pre-foreclosure bailout for the seller, so that he didn't have to take that hard knock on his record. But it also meant that we could be very aggressive with how we negotiated the price point.
Yeah, that's incredible. So like, just a lot to unpack, but we've got a broker relationship. We're seeing deals all year long. And of course, when the deals come in, if they're in our buy box, we're underwriting them. We've got an underwriting model and a spreadsheet, and we're taking the information they give us. We're putting in the sheet. We're making sure the numbers make sense. And then we're putting in letters of intent to purchase these properties. And, most of them don't work out. Like, we've probably put in dozens of LOIs just to get this one. And it's always a situation like this. I do think it's important to note we have a very specific model. We buy very specific properties. We're looking at C-class, which is around that 1970 time. We're looking at around that 100 unit mark, and there's value add opportunity, meaning we're going to turn the units. We're going to make them look a little bit nicer. We're going to improve the community. And that's what we look for. In this case, we got that, our buy box, plus we got some dysfunction on the seller side and some urgency based on their issues with the bank, which opened up a massive opportunity for us to get a great price. Now, you said this guy's in $22 million, and that's kind of what he was hoping to get back out of it. How did your negotiation go? What were you able to get the property at? And if you could just talk through that piece.
Yeah, absolutely. So as I said, March initial, let's scratch the surface. Let's start figuring this out. I was thinking peak of 18.5. I started learning more. That debt deadline started accelerating and getting closer. And we were able to do some more investigating. And I was like, this needs to come down, because we really need to start protecting ourselves here. Because there's some, just like, this guy's bank could foreclose on us. So we don't want to start spending money and stuff like that. So we eventually negotiated down to 17.2 with a condition that within 5 days of signing the contract, the seller had to provide a certification from their lender that they would not foreclose on us during our contract period. And the lender's like, fine, but you guys need to get in and tour these units and be able to commit hard money as quickly as possible. And we're like kind of back and forth on some of that. And literally over the 4th of July holiday, we were able to mobilize our asset management team, get them on site, get into every available unit that we could possibly get into, and prepare to sign a contract. The problem is that we discovered in those unit tours some information that the seller did not previously disclose to us. And that was that The units were built in the mid 80s, which is actually good compared to our typical model when we're dealing with like 1970s products. So we're getting newer units. Is they had an issue with polybutylene pipes. And so if anybody hasn't dealt with polybutylene pipes, they just have a tendency to break. Like the joints aren't good. They don't last as long as they should. They're not as good as PVC or copper. And the seller didn't disclose the extent of those issues. So we knew at that point in time that the seller knew we were likely the only people who could close in the timeline that he wanted us to. So we very quickly met with contractors, met with some other people. Again, we're bugging people over a holiday weekend and put together an estimate of what we knew it would cost to go in and replace all this piping. Went back to the seller, buffered that by quite a bit so that the seller would then settle where we wanted him to do. And basically we're like, you're either going to close with us at 16.2 or you're not going to close this property and you're going to have a foreclosure on your record. And he was not happy with us. But I was like, this is your decision not to tell us. So you can be not happy with us, or we can make this happen and make sure that you get off scot-free. And he came back to us a little bit later that day and was like 16.5. And I was like, that's where I wanted to be anyway. Thank you. And we ended up under contract at 16.5, but with a very quick contract to close of it ended up being only about 63 days in order to make that happen. And we had to also commit to a significant amount of hard money up front, which we had our previous conversations within internally of like, if we can get to this really safe price point, knowing that even if we just made bare operational improvements, we could sell it at a profit. So we knew we could go in and safely execute on that and then deliver an even better opportunity to our investors once we're able to make improvements and really turn this property into what it possibly can be.
Yeah, I think the absolute critical part here is like, it's extremely conservative because we have to make some assumptions, particularly when it comes to the unit, the condition of it. Of course, when we go into these properties, we literally walk into every single unit, get eyes on, and have a standardized checklist and way that we're looking at in these units. But like when something's in the walls, like plumbing, you've got to make some assumptions. So I'm a part of this call. So when David says he's talking about our team. Our team is 5 primaries and then 4 or 5 different other people who are also part of our team. And it's not just like me or David. We've got an army of people who are getting eyes on this and have different skill sets and expertise, which is really powerful. So when we go see a problem like that, that's potentially behind the walls, we go, hey, let's get an actual quote from a plumbing company to say, if we had to replace all of this, what's it going to be? And it's, getting up closer to $1 million, $700,000. And instead of eating that and like trying to fudge it in our numbers, like we have to get that off the purchase price so that we can get a great return for our investors. And, these multifamily deals are longer burn. They take more time and they're a little different. I think a lot of people, or there's more people in residential than commercial. So they think like these commercial deals or these residential deals, they move really fast. Well, these deals, we get an LOI, we go see it, we go back and forth. We got to get all the paperwork. We got to get all the leases. We got to get all the documentation. So there's like physical due diligence and there's administrative due diligence and there's financial due diligence. It's a whole project just to get everything you need to get to solidify numbers, ultimately to go to the closing table. And, you negotiated this one. So hats off to you on that. Let's talk a little bit about this deal and the way that we buy these deals. It's like, man, David and Adam must be rich. They can just go out and buy a $20 million asset. Can you talk about how we use leverage responsibly to buy these assets and what the stack for this one looks like?
Absolutely. So you're probably going to hear me use the word syndication, which I'm hopeful that many of your listeners have heard. But the best way that I like to think about deals like this is almost all of us have heard of the stock market. And when you think about the stock market is you have shareholders who put money into a deal or into a company. And then you have a board of directors and officers who use that shareholder equity to generate profit, to conduct their business. And so that's basically exactly what we're doing is we as the general partners vet the property. I like to say that we try to poke as many holes in the deal as possible before we go under contract. And even after we go under contract, if we need to get out, and then see which one of those we can conservatively plug. During that process, we also partner with financial institutions to understand what percentage of the property can we cover by debt. Debt has a positive of typically being a lower cost of capital. And so you've got a fixed interest rate, you know what it's going to cost, but it has a negative in that that is a contractually obligated term so that you must pay that exact amount of money at that exact time, or your debt provider can foreclose on the property. The second piece of our capital stack, our investors, are equity investors. So the risk factor of being an equity investor is a little bit higher because you're like, oh, well, the debt provider gets paid first, I get paid second. There's no guaranteed payment terms. And so you're really investing in the team and in the property and what they've done. But the returns for equity investors are significantly higher. So we work closely and carefully to try to balance those two factors. Some people you'll see will try to max out their debt. And what that means is that it's a really tight set of returns for their equity investors and potentially even like getting into negative elements where debt payments exceed income. We try to develop a balance where it's like, we know we're safe and we know we are well above the debt service coverage ratios that we have to preserve, which does mean that we may have to bring in a larger group of a larger dollar amount of equity investors than other people would, but we're more confident in our ability to pay those returns. And we run a lot of analysis. Like that's kind of one of the things that I have to do is I look at different equity pool sizes and where we can do things and run analyses of what's the likelihood of hitting our projected returns versus what's the window on that. So meaning like, we might say, hey, we've got this really great return, but there's a 90% window we're going to hit, or 90% chance we're going to hit somewhere between here and somewhere between here. It's a really big window. Whereas other times, maybe it's like we've got a marginally lower return, but it's a narrower window. So we're safer in our projections to be able to hit that. That to us is a better scenario where we're more likely to predict what we're going to actually be able to do, especially on the negative side of things. Like if the positive side wants to go crazy, we can't account for that. Like love to hear that. What we want to account for is minimizing the downside. So with this particular deal, what we were able to get with our lender is a 5-year term loan with a fixed rate. And that rate's going to be set a week before closing. It'll be the 5-year T-bill plus 265 basis points. So if you were to do that right now, you'd be at about a 6.32% interest rate. We underwrote it a 6.75. So we're actually 43 basis points to the good. The Fed meets on September 17th through the 20th. They're anticipated to drop rates another quarter to half point. So we're projecting at least another maybe 5 to 10 basis points of reduction in rate prior to then. And then that rate's locked for the full duration of our term. We got a 75% loan to value of the purchase price. And then we make up for the rest of that with our equity investors. So our equity investors cover 25% of the purchase price, all of our closing costs, as well as our operational reserves and our capital expenses. So our equity pool on this is about $6.65 million. So you add all of that up and it is $19.025 million, if I can do math off the top of my head very quickly.
Okay. So between the debt on the property and the 6.65 million from equity investors, it's a total of 19 million.
0.09. Yeah.
Yep. And I'm not sure if I heard you say this. So this asset, like if you're listening to this, you Google Triangle Park and you look at this asset, it's a really great looking asset as it sits. And there's some room to add value, which is our game. No doubt about that, but it looks good. Here's the beauty. This is my 2 cents, is that it was occupied at 70% when we started this journey of buying this one. So knowing how we value multifamily, it's not sales comparable model like residential. It's based off of the net operating income and the cap rates. Well, the thing that we control the most is the net operating income.
Yep.
So if it's only 70% occupied and all we did was come in here and influence management to do a much better job like we have on our previous assets and filled it up to 95%, which by the way is common to everything else around this asset. And it's 17 minutes from Duke University. So this is a great area, right? Did I get that right? 17 minutes? I think that's...
and honestly, I mean, Duke University isn't even really the closest great location. I mean, we've got Research Triangle Park, which is 60,000 like medical research jobs. NIH has a medical research facility right down the street from it. We benchmark a lot of our real estate based on multi-billion dollar corporations and where they're going. So we look at companies like Whole Foods, Chick-fil-A, Chipotle, Lowe's. Like if we know they're in the area and they're anticipating that this is going to be a long-term sustainable area, like we do that. All of those are within a 10 to 12 minute drive.
So great location.
Yeah.
Great location, an opportunity to simply just fill it up. Obviously, you do value add, you can bump rents a little bit. So there's a lot of control factors, right? Because in all these deals, there is some risk and there are some assumptions that get made, like on what the exit cap rate will be in 5 years. Right. We obviously try to project that as conservatively as possible, but that's no matter what we do, it's still a projection because it's not 5 years from now. But we do control our ability to influence the occupancy or vacancy of a property. And, the controllables are the things that we're best in the world at, in my opinion. Like we go and we get fixed rate debt. Is a good deal with a good bank and it's for 5 years. There's no bridge money. We're not going to come up against a refinance when we don't know what's happening in the debt market. So I really love that aspect of our business model is we really do focus on the controllables and we try to be really conservative on those things that we have to make assumptions on, that everybody has to make an assumption on. Let me ask you this, David, because this deal it's my personal favorite we've done to date. And our deals were so good last year that on the one we bought in July, we are distributing distributions to our investors early, a quarter early, which is pretty phenomenal. On this deal, when I look at this deal, I think this deal it's better in a lot of ways. Most ways, in fact, in my opinion. Who is this deal for? Like, who can invest in this deal? Like, what credentials do you need? Is this like investing in the stock market? And then what kind of returns could somebody expect?
Yeah, well, I'll hit a couple of things first that you had touched on briefly there, and then I'll jump right in answering that question. So one of the things you hit on is like, you're like, oh, it's a $19 million capital stack and this and that. Like what you didn't mention there is that in this process, we also got our as is appraised value. So as is at 70% vacancy, the appraiser, the professional, thinks this property is worth 19.15 million or 19.14 technically. So we're already going into this with 2.6 million in equity, basically in the pocket. So if we had to turn around and sell it right away, we would be able to get a return as long as we find a good buyer. The other thing is that you hear a lot of people talk about like, oh man, the different proposals about raising rents and this and that, and where they're going to put a rent cap on things. We're projecting going in and lowering rents, which is weird and not something you necessarily hear about. But we understand that our goal is to provide the best quality community for the best prices and build a good relationship with our tenants so that we encourage them to be a part of us for a long period of time. So like instead of people moving in, moving out, like we want to incentivize our residents living with us and building the community for years and years and years. So we're not building our model based on, oh, I've got to hit a 10, 15, 20% rent increase. It's like, no, we're actually going to renovate and drop rents because we think that will, instead of getting unsustainable, I hope tenants, we're going to get the home run. They're going to pay tenants and we're going to be able to keep them and stay at 95, 97% occupancy. So that's where you kind of then bridge into what sort of investor. So this is a 506C opportunity, which means that you do have to be an accredited investor, and the IRS has an SEC have a definition of what that is. So I don't want to repeat that here because for posterity's sake, they could change it. But you can Google what is an accredited investor and find that out. But really what this is this is somebody who is looking to say, I'm tired of the stock market bouncing up and down, rolling into an election, which is always a volatile time. Every week you're going to be like, it's up 10%, it's down 10%. And depending on which industry is or isn't, you're going to like give yourself heart palpitations. This is for somebody who says, I'm probably either mid-career towards 75% of my career. I don't need these retirement funds for 10 or 15 years, but I'm already making a good amount of money myself. So I want to be conscious of building a blend between profits as well as tax advantages so that like I'm not just getting hosed on capital gains every time I turn around. But also somebody who is like, listen, I want to find people that I connect with and people whose ethics I believe with and people who I understand how they're conducting business and are going to be transparent and honest with me. And I want to put money there because I know if I have a question, it's going to get answered, and it's going to get answered in a clear and substantive way, not just a like, well, but what about in this and that, and like try to talk you around 6 different ways like every politician seems to do about any sort of controversial issue. And somebody that hopefully also is, once they see how we operate and the level of communication that we have and the level of performance that we give, is eager to say, let's do this again. Like, we're not looking for a one night stand. Like, we're looking for a long-term relationship is probably a good way to put with that. And that's where we really pride ourselves on, like, we let our performance speak for ourselves. And so when we do a great job, people want to turn around and invest again. And to us, that is the biggest piece of we've done our jobs well, is our residents renew with us and our investors renew with us. And that's the biggest piece.
Yeah, I'll just touch on something real quick because I'll give a personal anecdote from my personal position. So last year, multi 6 figures, almost 7 figures in earnings. And, that comes typically with a pretty big tax bill. And I remember early in Q1 or early Q2 last year, I sat down with my CPA and we did some projections, and he said, well, Adam, you got to get some apartments or buy a vehicle this year, or else you're going to give all that money away to the government. And I said, oh my gosh, okay, well, I hope we can find a great deal that we want to buy. And then fast forward to the end of the year, really 6 months into the next year, by the time my taxes are wrapped up, waiting on all the K1s, of course, I ended up with a tax bill of about $1,500. And you said this when you described the person that this is a good investment for. Of course, the returns are good. They project to be pretty good. Like, kind of bottom line is like double your money in 5 years is the game plan, right? That's great. Everybody would love to do that. But what I really love is to keep my money this year.
Yep.
Right. So if you're earning like multiple 6 figures or 6 figures and you're going to pay a bunch of money in taxes, depending on your personal tax situation, there's an opportunity to reduce your taxes significantly. Like, mine were reduced almost to nothing last year. And I know plenty of other real estate investors who really continue to defer their taxes further and further down the road. Of course, yes, there is recapture. You could defer all the way till you pass away and do a step up tax basis to your kids. But, you're in your highest earning years right now. Maybe I'll be earning less later and it won't hurt as bad later. So it's just like a tax strategy thing, and it can reduce your taxable burden in the year and you can defer it. And that was like my story from last year, really impactful for me and our family in building our wealth. Because what it really allowed me to do wasn't about giving the money to the government. It was about being able to, it was the utilization of my capital. So instead of allocating 30% of my funds to go to the government, I can continue to reinvest that 30%. And now I get this compounding effect over time where I don't have to give any of my, much of my money to the government, and I'm able to just continue to build generational wealth for my family.
Yeah. And honestly, the side piece of that too is that as you continue to reinvest in opportunities that are creating better quality housing at a more accessible price point, that are creating employment opportunities for everything that we're doing from a value add perspective, it's like we're actually doing things that, in essence, spending the tax dollars more efficiently than the government would. And so, like, we encourage people. It's like, we'll provide you with the numbers of what we're anticipating for bonus depreciation, for long-term depreciation over the project or course of the project, and go talk to your CPA. Like, go talk to your tax planner. Like, we want you to have those conversations because we want you to understand exactly what of that you will be able to utilize and when you will be able to utilize that. So just real quickly, so everybody's like, well, what do you mean by all of this? And what are the dollar amounts? So we've already consulted with our cost segregation specialists who are going to help us take advantage of what's referred to as bonus depreciation, which is at a 60% level for 2024. And so based on their analysis, if you were to invest $100,000, and I'm just using that's not the minimum, but that's just a easy round number of $100,000, your year one bonus depreciation allocation is going to be about approximately $30,000 to $32,000 based on the analysis that we've seen thus far. And then your years 2 through 5 is going to be a combined, again, approximately $27,000 allocation. So for the 5-year duration of this project that we're projecting that every investor is going to get 58% of their initial investment back in bonus depreciation. Now, every taxpayer has their own situation, but we will give you those numbers. We'll give you the kind of when we're anticipating it and what it's going to look like and how it works, so that you can sit down with your CPA and say, hey, what does that do to offset my gains from this? Like, I think the question you would have to ask your CPA is it better for me to be taxed on 100% of the gain that I would get from selling stocks, or is it better to be taxed on 42% of the gain that I would get from selling real estate?
Yeah, that's the cheat code. I mean, it's the cheat code. We talk about it a lot in real estate, but that's not, if you're an engineer, nobody's talking to you about how to keep more of your money. You're just trying to get the next promotion and make more because you're spending more on taxes. If you're a doctor, same kind of thing. You're making more and more money every year and you're paying more and more taxes. So eventually, I think naturally you stumble upon real estate, but it's just such a great tool, not just to earn and double your money, but also to keep more of your money. If you can, let's talk a little bit about what we model projections. Now, obviously these are projections, is what based on our modeling, our risk analysis, and our business plan that this asset would do for an investor.
Yeah. So there are a number of different factors that go into that. The first of which is, what are rents in the immediate vicinity and who are the residents who are paying those rents? So we want to understand, are we the top end property surrounded by a bunch of barely habitable slumlords, or are we a mid-market property, or are we the diamond in the rough surrounded by a bunch of class A that are just juicing people for every possible dollar that they can get out of them? Because that's going to impact who we think we're able to get to. It also tells us a little bit about where people who live in that area work and what sort of stability that they likely have in their income. Triangle Park is fantastic because we are a C class surrounded by A class, and we are surrounded by A class employers, which the A class units are charging about $1,000 per month more than what is currently being charged at this property. And so those A-class units are just sucking everything they possibly can out of their residents. And there are people that are just like, you know what? I'm tired of paying that amount of money. Like our younger generation is spending record amounts of money with experiences and going out, eating out, going to bars, doing stuff like that, especially post-COVID when like the sub 28, sub 32 generation is living in less expensive, smaller places and spending more money doing things out of the house. And so like when we're looking at healthcare firms, investment firms, stuff like that are bringing in recent post-grads, those recent post-grads are like, I want to spend less money because I know I'm not going to spend much time in my apartment. I'm going to be hitting the bars. I'm going to be hitting the restaurants. And so this gives us an opportunity to offer something to that very large population group that is currently underserved within this market. So would you rather have a renovated unit with 90% of the amenities that the unit down the street has that was built more recently, but it's 60% of the cost or 55% of the cost, depending on kind of what type of unit? The second piece that we look at is we look at market dynamics. We look at the economic and population stability of the market. And I will tell you, we're really excited to get into the Raleigh-Durham market. It has been one that we've been trying to break into for a while, but it's also been such a hotbed of money pumping in that it's driven prices through the roof for acquirers. And then when you put on top of that, that interest rates have gone up in the last couple of years, it creates a tight squeeze so that the opportunity for investor returns gets really, really narrow. Well, the nice thing is, because we were able to negotiate so much off of this property price and we were able to buy it from a seller who had put themselves in tremendous distress, we rebuilt the gap needed in order to give our investors the return they want. The other beautiful thing is that we're at what we anticipate is going to really be the peak of not only the interest rate market, but be a peak of the cap rate market. And that's the third piece that we look at is like once we establish there's high quality, stable employers, then we look at what's going to happen. What's the likely trend with exit cap rates? So the Durham market as a whole has been running about a 5.2% cap rate for the last couple of quarters. That's a full 130 basis points than they were 12 and a half to 18 months ago. So you get into like early 2022 toward mid 2022, Durham was trading at about a 4 to a sub 4 cap rate. And so people aren't familiar with cap rate. The low cap rate is better for sellers, but worse for buyers. And so we were able to get in at a high cap rate at a negotiated, like significant discount because of a distressed seller. And as interest rates start dropping, we're going to likely sell at an even better market cap rate than what we got in. So our exit cap rate that we projected on this, just again, to be reasonable, to be conservative, is we projected a 5.4% cap rate. So I just told you that the high of the market is a 5.2. We still bumped it 20 basis points over that because we know we're not an A class with stuff like that. But likely the market cap rate that we sell at is going to be mid to low 4s in terms of where the market is. And so that creates a buffer in there for us having improved a C, probably to a B minus quality property, maybe even a B quality property with amenities and stuff like that. And so we're projecting that we're going to be well within that range. The other thing that we look at is we anticipate kind of like long-term vacancy trends, looking at market absorption and construction levels and stuff like that. Those political things that I talked about earlier of like, hey, we're considering limits on rent rates and stuff like that. If you combined limits on rent rates with already record high construction costs and significantly higher interest rates, like the construction industry is already struggling to get units to market, whether it's in single family housing or multifamily housing, because their margins are being squeezed so tightly. And if you now have a federal policy coming on top that says you can't increase rates by more than 5% per year, nothing's getting built. Like they're basically just saying like, no, your costs have squeezed so that your profits are already limited. And now we're going to put a cap on your profits. Developers are just like, we'll go do something else.
Which, by the way, is a big deal, because all the hedge funds that were buying residential switch from buying existing assets to building new in a build to rent model. So They came in and the hedge funds took their billions of dollars and put them into the hotter markets, the North Carolinas, the Floridas of the world, the Texases of the world. And they started building entire neighborhoods with a model to not sell the property, but to rent it out. So now you're going to zap out billions of dollars of institutional money, and they're going to have to find other places to put it. So yeah, builders aren't going to be excited to build. And we do have a significant shortage of housing. I've seen projections ranging from 1.2 million houses short up to 1.7 million from Moody's houses shortage on the year. And we're not building at that rate, which means we're not going to beat that shortage.
Yeah. Oh yeah, no, I mean, it's the housing shortage is absolutely something that is a significant concern. And it's a significant concern because it's also something that most directly impacts middle to lower economic classes. And that's exactly the area that we're operating in. Is again, we're shooting to provide the best quality housing for workforce housing for people that can do it. I mean, like in a market that is charging $2,200-$2,300 for a one bedroom, which is absolutely insane, we're projecting $1,200. I mean, like we're not trying to change or move things around. It's like we're putting ourselves in what is hopefully an inflation insulated area, in a recession insulated price point. And is a price point accessible to people who are currently struggling to make ends meet, that are just getting pressured up and up and up, that can say, you know what, these people understand me. Like they grew up in my shoes, and they're providing the best quality living environment for me. And that's where I want to be.
Yeah, it's incredible. We love Triangle Park. Obviously, we've got this deal at a great discount, which gives us a ton of opportunity to outperform our projections. And that's really what we aim for, is to project with a keen eye and to be conservative in our projections, as conservative as we can be with what assumptions we have to make. And we try to make room so that we can outperform, because like David said, our goal isn't for you to invest in one deal, but to become a lifetime partner and come on this journey with us over multiple deals. So, David, that's like the most incredible explanation of how deep we go into some of these markets and what we're doing. And by the way, while we are breaking into Durham, I think almost all of our assets are in North Carolina. Certainly the last two we bought last year, they're just in Jacksonville. So we're just talking about a different metro, kind of reestablishing in the same state that we're very familiar with.
Yeah, I mean, we're also talking about the fact that we fly into Raleigh-Durham Airport, which is 15 minutes away. So instead of having to drive 2 hours to the nearest property, we can actually drive 15 minutes to the nearest property. And it's like North Carolina as a state is fantastic for doing business. From a landlord perspective, we love being there, but it's also why you hear a lot about companies that are making significant investments, whether it's in EV battery manufacturing or tech companies. Biotech is huge. I mean, when you talk about Duke University, you're like, oh, Duke, like we think about basketball. What is the major driver of Duke's economics is their health systems. And so between Duke and then right down the street, I can't forget to mention UNC. So nobody just chooses not to invest in with us because we didn't talk about both sides of the college basketball rivalry. But UNC Health Systems and the university as a whole is another major economic impact in that area. So it's not just like, oh, we've got professors and stuff like that. Like these are two huge universities that are on the forefront of driving medical procedure and technology development, which is exactly why Research Triangle Park is there. And the beauty of medicine is it's yet another recession-proof industry. Like even if the economy is tough, it doesn't mean people stop going to the doctor. And so it just means that likely money keeps flowing through that area.
Yep. We just like when the pandemic hit, nurses were at a premium, doctors were at a premium because that part of the economy does not sleep. This is great, David. What question did I not ask that I should have asked you about this apartment?
Yeah, I think, what we didn't talk about, and we have a lot of content that I'm sure you're going to link to in the show notes that talk about this, is we've talked about what happens up to the point that you acquire the deal. That's 10%. Like it's kind of the cool 10%. We got to negotiate. We got the appraised value. We're going in day one with 2.6 million in equity. Those are easy numbers to talk about. What you don't see from an investor perspective and what you don't necessarily understand is the nitty gritty that happens once we acquire it. How do we make the property better? And I think that more than anything is where we excel. And we have a fantastic team on the asset management side that's led by Frank Coopersmith, and like they go in and just like understand this property down to the studs, down to the wiring. Like we know everything about every little plumbing fixture in the units and appliances and stuff like that. And they take everything that we do to improve the property personally and engage with it on an individual level and make sure that we're actually meeting those things that we talk about in the acquisition. And so I'm here talking about the 10% when in reality that 90% of the iceberg is underneath the water. And so that's the piece that I think we excel at. And so when you look at our communications and you look at the story of what we've been able to achieve at the properties that we've already had for a year, 18 months, stuff like that, that is what allows us to do that. So we don't just hire a property manager and say, go figure it out. Like a part of our contract with our property manager is we're involved in the hiring. And our whole team is involved in figuring out, like, are they the right cultural fit? Are they the right face for the brand in terms of just like that passion and energy that people want to connect with? Are they responsive to our residents? So are they somebody who takes the resident experience as personally as we do? So when somebody says, I know it's Friday night, it's 5:07, you got off at 5, but my HVAC just cut out and it's Memorial Day weekend and it's going to be 95 degrees. Like, do we want somebody who's like, yeah, call me Tuesday? Or we want somebody who's like, listen, let me make some calls. Let me get this taken care of for you. That's who we want. Like we want that person who's going to care for it. And so we're directly involved in the hiring, directly involved in the support process, and also selecting vendors and contractors who are going to come in and understand that like, we don't want to pay you 50% of the price to come in and fix this every 6 weeks. We want to pay you 100% of the price to fix this once and be done with it. Like, stop putting Band-Aids on broken bones. Like, you may need to cast it. You may need to surgically reset it. It's going to cost more upfront, but it's fixed. And so that's I think what really sets us apart is like, once it actually is time to put the nuts and bolts and put the like money where your mouth is, that's where we excel.
Yeah, I love that because we're going to do it the right way. I can name a couple examples just off the top of my head, but the polybutylene piping is one example that we were on a call about this property. I think it was yesterday. And it was like, hey, with polybutylene piping, we could just replace the joints. And everybody was just kind of like, yes, but then we'll have this problem later. we're not trying to kick that can down the road. Let's replace everything and do it the right way the first time. So the tenants have a great experience so that they're not having to call maintenance to fix problems. And you're right. What was really cool is a couple of things. One, we actually go see these properties. We're not like boots on the ground or taking care of it and we're just running spreadsheets. We go into these properties. And I remember when I was walking Cardinal Village, just the information I was able to gain to help our asset management team from the tenants. Like, hey, I've put a request in for this water leak 6 times, and each time they say they'll come, and a week later nobody comes. Well, that's a big deal, that person and to that person. And when we can in place our business plan and our property management standards and our on-site management standards, and we become just something as simple as being responsive in a reasonable amount of time, like that increases that community's feel exponentially. Those people are extremely happy. They're going to stay in those units for a lot longer. And this is cool because in the ones we bought last year, like the tenants are going, when are those units going to be done? I'd like to move from mine into one of the newly renovated ones. They want to stay with us.
Yeah. Yeah. And I think that's an important thing is like, we all remember our connections, whether they're in childhood or young adulthood, of like being tenants or being somebody who needs something and getting ignored or getting that request fulfilled. And so it's like, we've stayed connected to what it feels like instead of just being like, oh, well, we're business owners. We're trying to build cash and stuff like that. It's like we're emotionally and mentally and physically invested in each of these properties and are treating, like taking it personally to make sure that it's the best place it can be.
Yep. And that, to your point, like getting the deal, raising the money, bringing the investors in seems like the big heavy lift, but really it's the 5 years of execution on the business plan behind it. And part of that is the care for the folks that we have an opportunity to care for. Man, David, this has been easily one of my favorite interviews. One, just because I know you so well and I know you're such a professional and I know you're always going to bring correct, accurate, and good information to people, to include me and keeping me on my toes. So, man, thank you so much for spending your Friday afternoon with me. I'm grateful, man. I'm just grateful for you. And I'm excited to being able to buy another apartment with you, man.
Absolutely. And the other thing too, that I think is important to understand is like, we've been talking about a current deal, but likely there are going to be people who hear this after close. I mean, if you hear this as it comes out, we would love for you to reach out to Adam and say, hey, I want to get in. How do I get in? Let's talk more about terms, see the offering memorandum. But for people that hear this, maybe let's say October, November, we're closed, we're operating, please reach out. Let us know what questions you have about how it's going, but also get us, like, have a conversation with us about what it's like to be involved with our team and be ready so that when that next deal comes, you're on the list. You're going to have a chance to hear about it early in the process. And you can participate in some of those and hopefully benefit from some of those as well.
Yeah, that's so good. Here's what we do different than anybody else I've seen. I'm invested in other people's syndication deals. Number one is our openness and transparency, which comes with some risk. We open our doors and show everything. Like, you want to see our underwriting, you can see it. You want to come to a call with us and go through our underwriting and how we evaluate the risk in the deal, because there is risk. It is an investment. Every deal has risk. But you want to see how we're mitigating it and how we believe we're making safe assumptions, we'll invite you in. If you want to come to our asset management call where we're talking about the apartments and what we're doing on a weekly basis, we'll invite you to come see one of those, because we know we're doing everything above board. We know we're operating with high standards. So we're happy to invite people into things like that. So if you're interested in multifamily, if you're interested in being an investor or seeing how we do it so that maybe you can be an investor in the future, definitely reach out. I would love just to come and show you what we do. I think you'll really enjoy that. So thanks, David. I hope you have an amazing weekend, man. I know you've got Melissa and kids and dogs and all kinds of stuff going on over there. So grateful for your time, brother.